So the neat thing about working for a startup is you make a lot of mistakes and you learn a lot of stuff. The neat thing about being a VC is you get to work with lots of startups and watch them all make mistakes, different kinds of startups, and learn different kinds of stuff. So what we're going to do here today is kind of go through some of our experiences with the different companies that we've backed, and hopefully have some ideas and suggestions that you can apply to your businesses to help you think about growth. But first, I'd love for these guys to introduce themselves.
Sure. Well, thanks, Matt. So my name is Philippe. I work with Accel. So Accel, so we're a global venture firm. We started 30 years ago in Silicon Valley and expanded in Europe. So we have an office in London, as well as India. So we're one of the very, very few early stage firm with a truly global network. And it is that network that we give to our portfolio. So in terms of stage, I mean, the core of what we do is a $5 to $20 million investment in the series A, B, or C. We also have a growth fund, so we can go up to $100 million. And very opportunistically, we can do a seed of $1 million or two. And we're very active in SaaS, of course, but also cover consumer technologies and fintech.
So I'm Sitar, I'm a partner with Connect Ventures. We are a London-based seed fund. We invest across Europe. We've been around for 6 years, so quite a bit newer than Accel. And we focus on product-focused companies. So we like to back the best products coming out of Europe, both B2B and B2C. But we've done quite a few SaaS companies as well. Probably best known is Typeform, which is based in Barcelona, but we have a few others as well, including Soldo, CharlieHR, Marvel, and a few others.
Great. And my name's Matt Lerner, and I'm a partner with 500 Startups. We're a Silicon Valley-based early-stage VC fund, although I'm based here in the UK. And we've invested in a lot of companies. And my own experience prior to becoming a VC was doing growth marketing, performance marketing for PayPal, and a number of startups. So I work with our portfolio companies to help them at seed stage learn to scale their growth. And I'm really glad to be on stage with these two because they're some of the finest investors in the UK. Accel and us, we've invested in some companies together like Algolia. Sitar and I have invested in a few companies together as well. Some really good quality companies. And I think, the best founders have a choice about who they're going to take investment from. And so that's why it's good to have high-quality investors like you. All right, enough tooting our own horns. Let's get down to it. When you look at your portfolio and you see some of these outliers, who's doing this really well and what worked? Do you want to?
Sure, I'll start. So our kind of core thesis, we look for companies that are building the best products in the world. And so one thing we see is that a lot of the companies, especially in the initial stage, rely a lot on their product for growth. And it could be that it's the product that's growing because it's just an exceptional product, so there's a lot of word of mouth. It could be that it's growing because the product itself is built in a viral way. That's what drove a lot of Typeform's early growth and continues to drive actually a lot of its growth. So that's what we see go really, really well. Do you want me to go into it? I'll wait till for the mistakes.
Okay. Philippe?
So that's a good question. So let me start with an example. So one of the company I invested in is called Docusign, which is an electronic signature company. And so this company has reached massive scale, over 10 years. And for me, the key success factor for them was to start with something that is a need that everyone has. I mean, when you think about signature, put yourself back 10, 12 years ago and think about you having to take a pen to basically write your signature, or having to receive an email, to find a printer, sign, try to find a scanner, especially when you're on vacation and you're in your hotel and struggle to find it. And what Docusign came up with is a very simple solution. Is like just do this with one click. But the issue is that there were 50 other companies which says, well, that's a great idea. We can do the same. And by the way, we can also do it on mobile. But what Docusign managed to do is basically take something which is very simple, but then understand that if you want to do that at massive scale, you need to have a super robust infrastructure below it. And they basically adapted their product to add the security and the infrastructure so that the product could be used by individuals signing their mortgage as well as by Fortune 500 company. So for me, the key learning here is that it's not about the feature and what you enable, but it's about what's under the iceberg and make everything works at scale, at a massive scale.
All right. So it's great in those rare Goldilocks cases where it all works, but you see a lot of companies, some you back, some you don't, where it's not working. What are some of the most common mistakes that you see?
I can share. I think what we see probably across the board in our companies is when you, and you may have heard some of this come through in Dez's talk, when you back product founders, they tend to think product solves all problems all the time. We've seen a few cases where they almost have a distaste towards marketing and growth. Like it's a bad word, right? Like I don't really want to hire a marketer because if I hire a marketer, it means I failed in some way because obviously my product is so amazing, everyone should just come and use it. Like I don't have to tell anyone about it, it's that good. And that's just bullshit, right? Like that does not actually happen. You have to tell people that your product exists. And actually the better your product is, the more you want to market it because you have this really nice fire going and you want to really, really pour fuel on it. And so I think one of the mistakes we see a lot is an over-reliance on product and the sort of build it, we will come mentality. And so one of the things we've worked on, and we too have been guilty of this, I think, as VCs, because we love product, and we always find products kind of organically because people recommend them to us, and so it feels like that's just a natural way of finding great products. But what we've learned is, as early as possible, as soon as you have product market fit, you should really start figuring out what are your growth strategies and what are your channels that really drive growth. And it's not just not a negative thing, it's actually negative not to do it, right? Because if you don't know how to drive growth, you can't control your growth. If you're completely reliant on your product for growth, you can't grow faster. You can only grow at the rate that your product lets you. And so if you want to grow faster, you have to be able to control your chance of growth. And that's something that I think investors want to see earlier and earlier and earlier. So even though we do seed, and then the next round would come from an Accel, a lot of times the questions they ask are, well, how are you're going to raise X amount of money, how much of that is going to go to growth, and what are your growth channels? So I think having that knowledge earlier is much, much better.
All right, so first I just quickly want to follow up on that question because it raises, so Philippe's talking about Docusign, you mentioned Typeform. These are products where the product grew the product. I heard about Dropbox earlier today during Kieran's excellent presentation. So we've all seen these companies do it so well. How does a founder know when they shouldn't be trying to grow their product with more product?
You mean what's the limit of that?
Like how do I figure out that I'm not Docusign or Typeform and that that's not necessarily the right strategy for me?
I mean, you should probably know that pretty early on. Like if your product doesn't have a natural spread to it, like if your product doesn't fundamentally spread itself, you're probably not going to be able to rely on it for its growth. So you might be able to rely on some word of mouth for some level of growth. But so we have investments, for example, in a company called CharlieHR that does HR software. Doesn't really spread itself, right? People don't really share HR in any way between companies. It tends to be within the company you work at. No one's like tweeting out that they're going on holiday. And I know because they tried that. And no one wants to tweet out that they're going on holiday. And so you should know kind of from the beginning that your product is not one that has a natural tendency to spread itself.
Thank you.
Yeah, I mean, to elaborate on this, I would say that typically for SaaS companies, you have two models. You have one model which is product-driven and one model which is sales-driven. So just to illustrate this point, if you take a company like Algolia, for example, so Algolia is a search as a service. So if you're a developer and you want to build user-facing search, you can either use an open source product and configure it yourself and then have 2 or 3 people running it, or you can just upload your index to Algolia's API and have Algolia do it for you. That's, I mean, when you think about it, it's something that if you're a developer, you're going to, at some point, if you need search, you're going to go online and try to find what you can use, right? So this is a product that people will find. And if you try to find the developer by calling them, like, good luck. I don't know if any of you have tried to call the developer to sell him something, but just it doesn't it doesn't work. So that's a model where you actually need to focus on the product and then focus on the content, because what the developers are going to look for, they're going to look for interesting article on search, but very technical articles. So if you try to hire marketing person to write on search, that's going to be hard. But then if you ask your own developer to spend 10-15% of their time to write, that's going to work, and that's what drives the content. And then, and so this is a model where actually you pull people towards you by giving them information on what you're doing. And then there is the opposite model, and I'll take the example of Doctolib. So Doctolib is the French and German company which sells a booking management system for doctors. So it's very simple. Patients go online to the portal. They can book an appointment with the doctor. Doctor sees that on the calendar. So it's kind of simple. But then if you want, I mean, doctors are not going to go online and say, oh, I want an online booking. It just doesn't work this way. So what you have to do is be super aggressive on sales. And what Doctolib did, and that's what set them apart from the rest of the pack, they basically set up a sales force, which is now 150 people on the street, going door to door, going to the doctor. They've refined their sales pitch to the point where they actually know that to get to the doctors, you need to bring in France, you need to bring the croissant to the assistant so that she can book you in. I mean, these are the best practices. No, really, this is the best practices you see in their sales book. And then you force yourself, and then when you show the product to the doctor, it says like, yeah, of course, it makes total sense to me.
I think the other thing that to look for is your product in a space where it's kind of going back to Des's graph, is it a really hard problem that a lot of people have, or at least a significant quantity of people have? And the other thing we found with stuff that isn't viral necessarily is there a pull from the market that brings people to you? Because that's another, I mean, outbound sales works if you've got, I guess, a really, really great sales machine and probably a pretty high kind of annual amount coming from each customer. But ideally what you want is a lot of inbound sales coming. And one of the best ways is if you're solving a problem that lots of people have or have coming up because there's some regulation coming, which seems to be every month in Europe now, and they're searching for it, right? So some of our other companies that are a bit earlier, two in fintech actually, TrueLayer and Soldo, get a lot of inbound. And they get a lot of inbound because what they're doing is both very hard, there's not many companies solving it, and a lot of people have the problem, and they're looking for a solution.
Okay. I think the other common mistake that I see a lot is companies just focusing on the wrong part of the funnel for growth, like just not understanding whether they should be focusing on traffic or conversion or optimizing the sales process. And so when we start working with companies, we just sort of map out their funnel with them on a whiteboard. And so someone suggested I actually tell this story. But we had a company, and they were paying a lot of money for traffic, and they were converting that traffic into leads. And then we mapped this all out, and how many visitors and how many of them convert to leads. And then they have 200 leads, and they have to call them and qualify them, and then put them through a sales process. And we said, wait a second, you have 200 leads. Well, how long have they been in there? How old is the oldest one? I said, well, it's 3 weeks old. And so what's your conversion rate of lead to customer? 10%. And what's a customer worth? $20,000 a year. So that means each lead is worth on average 2,000 pounds? Yeah. And you have 200 of them? So you have 400,000 pounds of recurring revenue in a database, and you haven't called them yet? No. Why not? And you're paying to get traffic to put more leads in the database? Yeah. Why not? Well, we're really busy. What are you busy doing? And so, long story short, they ended up working the weekend, hiring another salesperson, adding some lead qualification questions to the website so they wouldn't have to call everyone to ask them simple questions. And the business really took off and recently raised a big Series A, and all is good. And I'm not going to tell you other details because it's an embarrassing story. But it's also one that when I explain it to you in hindsight, it all sounds like super obvious no-brainer. But when you're in the thick of it, and founders in the room, this, it's not that obvious. And it really takes someone to kind of pull you out of the business. Because if you're trying stuff and it's not working, your instinct is just to paddle harder. It's never to sort of step back and think, wait, maybe I'm focused on the wrong spot. So I guess the other advice I always give startups if their growth is stalling is just take a step back. Nothing's sacred, no assumptions. Where is the system? Where's the pinch point in the system? Where are the constraints? And because if you raise a round, you've got maybe 18 months of runway to get you to the milestones to raise the next round. And if you work really, really hard, maybe you can do 20% more work than if you don't work that hard. But if you're doing the wrong work, none of that matters. So the most important decisions you're making as leaders are we focusing on the right stuff? Should we be focusing on marketing? Should we be coming up with better developer relations content out there? Should we be trying to test virality in the product? So those key decisions about where to focus are really make or break for companies, and it's worth taking the time to get those decisions right. I think that's the other.
Yeah, and I think we've seen this with a couple of companies. Actually, one in particular that I won't mention the name of, but you've worked with, where they were really panicked because they had this kind of growth trajectory facing them that they wanted to achieve. And they're like, well, in order to get to that level of new MRR per month, we have to get this many leads on top. And they were working with Matt, and Matt's like, well, but look at your funnel. And you have all these leak points in your funnel, so why start adding in more and more people at the top when you're losing so many people along the way? And I think they hadn't ever really done their growth audit and really done kind of the analysis of their funnel and where they were losing people and when there were some really easy wins along the way. I think a lot of times we see is when you think about growth, you just think about the top of the funnel, right? And just adding in more people. So you go from no, I don't want to do marketing to, oh shit, we have to do lots of marketing and get in more people on top and not really thinking about actually what are kind of all the things that the users are going through before they become our customer, and how can we improve that entire journey?
I would say that if you look at SaaS companies, sales and marketing is a big chunk of the spend, if not the majority of the spend. And the challenge is that it's easy to say, well, I need to grow. So to grow, I'm going to spend on sales and marketing. But the reality is that a lot of that money is just wasted. And it doesn't make sense to hire upfront a lot of salespeople if you know that you're not going to have the pipeline to feed them, because that's going to be wasted. So I think it is very important for a SaaS company to really focus on understanding the go-to-market model and not over-hiring and not under-hiring. So that's striking this right balance, I think, is the most difficult thing. But in case of doubt, err on the cautious side, because you can always accelerate the growth later, but once the money is burned, it's burned.
So Philippe, you invest at Series A. Do you expect typically that companies are going to have that figured out by the time they get to you? Or do you sometimes need to work with companies and help them figure out their go-to-market?
So it's very interesting, because if I look at the past 10 years when I've been investing in SaaS, the market has really changed. In the past, a seed was financing an idea, a Series A was really to build a product, and then Series B was to try and figure out your go-to-market. But now it's become, so I shouldn't say so easy, but with the tools we have today, actually with a small number of people, you can do actually a lot on the product side. So now we're seeing basically super early stage companies which are a lot more mature. So I think in today's market, when you raise a seed, you already have a product, and then when you raise a Series A, you start to have a few customers. So if I look at the Series A I've done recently, first, they're probably larger Series A than they used to be, because they are more in the kind of 8 to 12 range than in the 5 to 6 range. And they're companies which are typically in the 80 to 100K in monthly revenue, and therefore they do have customer, and they have started to scale their their sales and marketing engine. But that said, we tend to see companies that are, earlier than that, and, where we're very happy to work with and help them find this, this magic sales formula.
All right. If you guys don't mind, I wouldn't mind switching the topic over to investing now, because I know a lot of the companies here are venture-backed and would be hoping to raise at Sitar's Series A. It's sort of a two-sided question for each of you. First, kind of what's the minimum criteria to get in a room with you? Like, what should a company be doing before it's a good use of the founder's time to sit down with one of you for an hour at your respective stages of seed and Series A? And then second, you probably see a lot of companies who meet those minimum criteria who you decide not to back. So what stands out about the best companies where you do end up being more likely to invest?
Go ahead.
Sure. So we have like a set of criteria that we look for, and it's a combination of you're building a product people love, you care passionately about the problem that you're solving, and the problem you're solving is both difficult, but difficult at scale, right? So and if you kind of break that down, the products people love, I think, hopefully everyone in this room understands that. You're solving a problem that you care deeply about. Think that, startups are hard, everyone knows startups are hard. If you are gonna stop because of a little road bump, you probably don't care very much about the problems. It has to be something that you're pretty committed to through all the ups and downs, and there'll be like way more downs than ups, so you really, really need to care about it. And then the hard problems at scale is there are a lot of problems that seem easy kind of to solve on a very small scale. So we have a company called Unmade that does software for customized knitted goods. That's like, you can make a sweater for someone, right? Like, that's not a hard problem to solve. I can customize a sweater for you. That's, I'm sure your like grandparents or whatever have done, whoever knits, I don't know, they've done that for you. But if you want to work with like Ralph Lauren and make tens of thousands of customized jumpers, that's a very hard problem to solve, right? So we look for problems that are very hard to solve at scale. Even if you meet all of those, we still may not back you, right? And it can be a combination of things. It could be the market's not big enough, so it's a hard problem at scale, but that scale is just not significant enough, right? And we're a seed fund, but we look for global outcomes. We look for companies that are really massive at scale, and that's probably the one thing which, if you meet everything else, you could meet all of those things and still be a company that's worth like a couple $100 million. And that's just not going to be big enough for us to get excited about. So I think that's probably the one thing which we have to take a view on and decide that that's not what we want to back.
All right, thank you.
Yeah, so to answer your two questions, the first question is like, what does it take to come and see us? I think it doesn't take much. I think the only thing it takes is a smart introduction. And when I say a smart introduction, it's just because I keep on saying this and everyone thinks it's obvious, but like I keep receiving like a ton of cold emails. And the thing is, with email inflow, the time you can spend on a cold email is very limited. So basically you scan through it and either it's something you say, well, you click on it or you don't. But the likelihood of this going through is much lower. But if I get an introduction from someone that I know and say, hey, you should meet this guy, he's great, usually you get the introduction. And so it's not very, very hard to come and see us, whatever the stage of your company. And even if it's very early, it may not be a fit for us at this point, but it's good to get the dialogue started. Now, in terms of what we look for, I think so. Our fund, the fund out of which we invest in Europe right now, is a $500 million fund. So typically we own 20% of a company, so we want the outcome to bring something back that is significant to the fund. So it needs to be at least $100 million. So we need an outcome of $500 million. So we need a company that can support this type of outcome. It's not that we're going to get there every time, but if we see that there is no chance of getting there, then it's going to be hard. And now I want to elaborate a bit on that, because a lot of people tend, and I think it's a mistake that I made earlier in my career, just to focus on the market and say, is the market big enough to support an outcome like this? And I don't like this notion of market, because market puts boundaries. So what I like to use, the term I like to use now is more the space, right? Are you in a space that can support, a very large outcome? And the difference is that, just to give you a simple example, if you look at Doctolib, for example, and you say, well, when we invested, they were just selling $1,000 a year subscription to doctors. There are half a million doctors in France, so it's a $500 million market, which is not a big market. So if you limit it to this, you're like, why should I invest in this company? Now, if you look at it differently and you see what space are they operating in, well, they're actually digitizing healthcare on a pan-European scale. Then you see that what they have done right now is just the first step, but it's opening a door to something that is much bigger. And that's why I call the space. So that's the first thing you want to see is a space that can support a big exit. And then the second thing we look at, I mean, of course, is a team that we click on, a team that we want to back, but every VC is going to say that. And then the third thing is a technology and a product. So we want to understand why now. Like, why is this technology happening now and didn't happen in the past? So what are the things that are getting together at this point that makes it happening? And is the company building moats that are deep enough to basically protect the company as it grows? So I would say for me, these are the most important things.
All right, thank you. We've got a few minutes left, and I just want to put it out to the audience if anyone has any questions for us. Oh, there we go. Our yes to no ratio. We look at about between 10 and 20,000 deals a year, and we do between 2 and 400. So low single digits percents.
We do 10 deals a year. I have no idea how many we look at. It's probably a lot, but we do 10. So it's really, really low ratio.
I would say it's 0.5 to 1%. But that includes all the companies we interact with. If I narrow down the ratio to the company where we have a first in-person meeting, I think it's probably higher than that. And then, when you start getting to the second meeting, then your chances are much higher.
Yeah, I'd say that's the same. I also think one of the things we do is, because we're seed and we're very, very early, we track founders. So it could be that I meet with the company, and we've been doing this now for 6 years, right? So there's like a whole group of founders where the first company wasn't the one we wanted to back, but we really like the founders, and we'll track them. And so maybe your lifetime ratio will be different, but the initial one might be a no. But if you kind of stand out as a founder, we'll make sure we're kind of up to date on what you're doing. And it's going to sound bad, but when it fails, we'll be right there trying to see what you want to do next.
Okay.
But I would say 100% of the startups that we have funded have tried.
Have tried.
To meet with us, right? So I think that's my message. Just come and meet with us, and hopefully, even if we don't invest, we try to make this meeting valuable for you.
All right. I'm actually, because it's a quicker question, I'm going to jump to the next one from Stefan, which is Sitar. What's the range of MRR you do seed at, and what MRR do your portfolio companies hit when they do an A round?
So the range is actually exactly the same for both questions. It's like 0 to 20. No, it's 0 to 20 when we meet with them. So we've backed a lot of companies pre-product. In fact, say most of the SaaS companies we've backed are either pre-product or they've got like 10K, like a very low MRR. And then at A, it's changing. Right now, last year, it's changing quite a bit to 0. Like we've had a company do an A round just pre-revenue, a $10 million A round, right up to like $100K, $150K.
All right. What do you do? I think this is a pretty quick one. What do you do if you like the product but not the founders? For me, it's very simple. We don't invest.
Use the product, but don't back the founders.
It's just a team's only certainly at seed stage. A business is only as good as the people behind it.
I think it's rare that you don't like both founders or all the founders of a product that's really good, but sometimes you might, like one thing we'll see is product's amazing, there's a problem with one of the founders or there's like a disconnect between the founders. And that's not something we would back.
Yeah, I mean, I agree. I mean, the average holding time for our portfolio company is like 8 years. So do you really want to work 8 years with someone you don't like? And the chances of if you don't like the founder doesn't really like you. So I mean, I don't think there is. I don't think it makes sense.
All right. Should we have time for one more?
No.
So we'll wrap it up now. All right, guys, thanks very much. This was a pleasure.
Thank you.